In early 2022, the crypto world felt unstoppable. A sense of digital gold rush was in the air, a feeling that fortunes were just a click away, waiting to be claimed by the bold and the savvy. Bitcoin, after a slump, was clawing its way back up the charts. NFTs, those quirky digital art pieces, were not just a niche hobby anymore. They were the talk of late-night shows and dinner tables, booming into a multi-billion-dollar market. And everywhere you looked, from Reddit forums to sleek financial newsletters, the new holy grail was passive income. The dream wasn't just to get rich, it was to get rich while you slept. Amidst this fever pitch of optimism, a project called Terra and its native token Luna began to shine brighter than all the rest. It wasn't just another crypto coin promising to go to the moon. Terra offered something far more revolutionary, something that felt like the final piece of the puzzle for a new financial system. It promised a stable coin, a digital token pegged to the value of a traditional currency, but with a radical twist. This stablecoin, called Terra UST, didn't need a vault full of actual US dollars to back it up. There was no bank, no corporate treasury, no old-world institution holding the strings. Its stability, they claimed, was guaranteed by something purer, something more trustworthy. It was backed by math, by elegant self-correcting code, by the sheer force of decentralized innovation. The message was intoxicating and it spread like wildfire. On YouTube, charismatic influencers with millions of subscribers leaned into their cameras, eyes wide with conviction, calling it the safest high yield in all of crypto. On Twitter, an endless scroll of threads, written by self-proclaimed experts, praised its decentralized miracle and its genius algorithmic design. It was a story of David versus Goliath, of a clever community-driven system designed to outsmart the slow, greedy banking Goliaths of Wall Street. And people, from seasoned crypto traders to absolute beginners, believed. They poured their hearts, their hopes, and their money into this new digital dawn. One of them was David, a 32-year-old software engineer from Austin, Texas. David was no stranger to code. He understood logic, systems, and the elegant power of a well-written algorithm. He wasn't a gambler chasing a long shot. He was a builder, a man who believed in the power of technology to solve real-world problems. He'd spent years diligently saving, socking away money from his salary, watching it sit in a traditional savings account, earning a microscopic fraction of a percent in interest. It felt archaic, inefficient. Then he discovered Terra and its partner platform, Anchor Protocol. Anchor was the engine that supercharged the whole ecosystem, offering a jaw-dropping, seemingly fixed 20% annual percentage yield on any USTU deposited. David did the math. He read the white papers. He listened to the podcasts. It all seemed to click. The algorithm, the arbitrage mechanism between UST and Luna, the booming ecosystem of apps being built on Terra, it was a fortress of logic. He decided to make his move. He pulled $80,000, half of his entire life savings, money he and his wife had earmarked for a down payment on a house, and converted it into UST, depositing it all into Anchor. To him, this wasn't a reckless bet. It was smart, forward-thinking finance. "The banks give you nothing," he explained to his wife, his voice filled with the quiet confidence of a man who has seen the future. "This is it. This is how we get ahead. We'll be early." The promise of 20% wasn't just a number. It was a pathway to freedom, a shortcut to the life they had always dreamed of. For a few months, everything was perfect. The digital numbers in David's Anchor account ticked upward every single day, constant reassuring stream of income that far outpaced his salary. He would check it on his phone, a small smile playing on his lips. The market could swing, Bitcoin could dip, but his UST balance was stable, and the yield was unwavering. It felt like he had found a cheat code for the financial system. The dream was real. He and his wife started looking at houses again. Their budget suddenly expanded. The future felt bright, stable, and guaranteed by the elegant certainty of code. But in the world of high-stakes finance, especially on its wild, unregulated frontier, the ground beneath your feet can turn to quicksand in the blink of an eye. The fortress of logic he had trusted, the one backed by a decentralized miracle, was about to be hit by a storm that no algorithm could withstand. The crash was coming. It began on a Saturday in May 2022. It wasn't a sudden explosion, but a series of tremors that quickly escalated into a cataclysmic earthquake. A few massive multi-million-dollar withdrawals of UST from a lending protocol created the first crack in the dam. This wasn't unusual in itself, but it happened at a moment of market-wide fear. Suddenly, the price of UST, the stablecoin that was supposed to be permanently pegged to $1, wobbled. It dipped to 98 cents. On trading charts, it was a small flicker, but within the Terra community, it was a siren. The automatic algorithmic balancing act was supposed to kick in. Traders were incentivized to burn Luna to mint new UST, or vice versa, to bring the peg back to $1. But this time, the selling pressure on UST was too immense, too sustained. As UST struggled, panic began to set in. The algorithm, which relied on rational human actors, was now facing a tidal wave of pure primal fear. The more UST's price fell, the more Luna had to be minted to try and prop it up, creating a massive inflation of the Luna supply. This caused the price of Luna to plummet. This death spiral, a theoretical risk that had been dismissed by believers as a black swan event, was now happening in real time, for the entire world to see. It was a digital bank run, and there was no Federal Reserve to halt trading, no government to step in. It was just the cold, brutal mechanics of the algorithm playing out to its terrifying conclusion. For David in Austin, the weekend started like any other, but on Sunday, he noticed the alerts. His crypto apps were lighting up with notifications about UST depegging. At first, he brushed it off. It's just volatility, he told himself, echoing the calm assurances he'd read from Terra's founder and the online community. The algorithm will fix it. It's designed for this. But by Sunday night, UST was trading at 95 cents, and the price of Luna was in a free fall. The confidence in his voice when he spoke to his wife was gone, replaced by a knot of dread in his stomach. He stayed up all night, glued to his screen, watching the charts flicker in the dark room. He saw his life savings, $80,000 that had become nearly $90,000 with interest, begin to evaporate. By Monday morning, UST had crashed to 60 cents. The collapse of Terra Luna was more than just a financial disaster. It was a psychological atom bomb. It vaporized over $40 billion of investor wealth in a matter of days. But its true cost was measured in broken trust and shattered dreams. To understand how it happened, we have to look past the code and into the human mind. The core of Terra's appeal was a powerful story that preyed on a combination of financial anxieties and tech-utopian beliefs. The psychology behind it was built on a few key pillars. First, the illusion of stability. By calling UST a stablecoin, the project anchored itself to the concept of safety. For investors like David who felt burned by low interest rates and volatile markets, stable was the most seductive word in finance. Second, there was the allure of complexity, which created a sense of authority. The algorithmic mechanism was intentionally difficult for a layperson to understand. This complexity was framed not as a risk, but as a feature, a sign of its genius. People trusted it precisely because they didn't fully comprehend it, deferring to the experts and influencers who evangelized it. The biggest mistake, however, was a catastrophic failure in risk management. Rooted in a single fatal flaw, concentration risk. The entire system's stability was dependent on the intertwined fate of two assets, Stahast and Luna, created by the same entity. There was no external collateral, no real-world asset insulating it from a crisis of confidence. It was a closed loop, a snake eating its own tail. When trust in one part of the system broke, the entire structure was doomed to implode. Investors like David and even sophisticated hedge funds made the cardinal error of believing that a 20% yield could ever be safe. In finance, high yield is always a direct payment for taking on high risk. The 20% from Anchor Protocol wasn't magic. It was a marketing budget, artificially subsidized to attract capital, ticking time bomb disguised as a high-interest savings account. So how do we avoid this from happening again? First and most important lesson is to distrust anything that sounds too good to be true. A guaranteed high-yield return with low risk does not exist. It is a mathematical and economic impossibility. Always ask, where is the yield coming from? If you can't get a simple, clear answer, you are likely the yield. Second, understand and respect true diversification. David put half his life savings into a single, unproven crypto protocol. True diversification means spreading investments across different asset classes, stocks, bonds, real estate, different industries, and different geographical locations, not just across different cryptocurrencies within the same volatile ecosystem. Finally, never invest more than you are truly willing to lose, especially in speculative assets. The money for a down payment on a house, your emergency fund, your retirement savings, these have no place in a high-risk experimental technology. The story of Terra Luna isn't just about a failed algorithm. It's a timeless cautionary tale about the dangers of herd mentality, the seductive power of a good story, and the devastating price of forgetting the oldest rule in finance: there is no such thing as a free lunch.